Welcome to TheoTrade. This is Don Kaufman. It's October 31st, 2018, and you are watching the TheoTrade evening video. About 20 minutes left in today's trading session. S&Ps rip to the upside in a continuation from some of the recent lows. With that, let's have a detailed look here at the S&P E-minis. Now, not everybody is necessarily in tune with the S&P 500 index futures. Get yourself in tune. These things are driving order flow to the entire marketplace, and we've got very specific levels that we term here gravity points on those S&P futures. Now, for literally weeks, we have been discussing these specific levels. And again, we're going to kind of enunciate some of these levels on this video and talk about the determination of some of these levels. First and foremost, you can see where trade kind of persisted from today. Where it started out happened to be none other than 2682. Now that's literally labeled right there, and the irony is happens to be the low of today's trading session. From 2682, we bounced directly to 2730, okay, which again, all of these levels have been described in detail on previous videos. In fact, if we kind of zoom out for a second, we've even got them labeled on our broader S&P chart. Now, the reason I want to talk about them is because, again, the market right now, in the midst of volatility, when everything seems, out of place and you're seeing the extreme of markets, yet, again, these marketplaces are adhering specifically, okay, to these gravity points. And one thing that I've talked about extensively lately is that in the midst of volatility, we're very likely just to see what we term the markets pinging from gravity point to gravity point. When I talk about pinging from gravity point to gravity point, again, here we happen to have again that 2731. We took off to the downside, stopped cold at 2682, a little bit of continuation to the downside before reverberating right back up to it, ripped back to the 2731. And again, all we're seeing is this ping action back and forth between these gravity points. Now, the number of emails we're getting about how we determine the gravity points, or how I specifically determine the gravity points, is almost to the overwhelming point. So I am going to spend just a few moments here, once again, describing how we're capable of pulling out such specific, determination points in a market that seems this extreme. And the way for me to do that is to describe for just a moment, and I'm going to kind of zoom out for a second here on the S&P futures. All right, what we have, okay, to determine these particular, what we term gravity points. And first of all, when I mention a gravity point, I don't want you to think of this, again, as support and resistance, right? If we were to pull right back up to this gravity point, think of it literally that way, that you're drawn to that point. That's why we call them gravity points. At that point in time, they become a doorway that can actually open to either exploding to the next gravity point to the upside, or, okay, pulling back in and shifting back down, which is precisely what we're almost pushing off the bottom of this gravity point. So how do we determine them? Okay. And really, all right, how do we go about deciphering, bias on these gravity points? First of all, in determining them, if you look at major trading firms, they carry some massive delta risk positions. And when I say delta, okay, delta is your directional bias. And you may have trading firms that carry millions and millions of deltas of risk. And these trading firms, throughout the course, okay, of trading, they use algorithms to actually hedge off, okay, their deltas. So effectively, let's say that some firm's delta, and I'll make this easy, was 100,000, okay, 100,000, we'll call it S&P deltas. It doesn't matter that's representative of the SPX, the E-minis, just let's call it 100,000 S&P deltas. As the market starts to move up, or as the market starts to move down, okay, they have algorithms that are auto hedging this delta, okay? So for example, if they're long 100,000 deltas, what that effectively means, we'll say for every 1 point, okay, that this product, for example, moves up or down, okay, this firm is going to make or lose $100,000. Well, that might be exorbitant amounts of risk, because for every dollar the S&Ps, I mean, please, the S&Ps today, what? They've had a range from this 82 all the way up here to the 2737. It would be huge. So what they do is they use an algorithm to keep this risk in check. All right. And by using an algorithm to do so, the algorithm literally has the capability of buying and selling, and it's going to buy and sell, okay, these S&P E-mini, okay, futures. And it'll buy and sell them in very, very rapid quantities. And by the way, you can't, people are like, oh, I want to see this going on. They're not going to trade 200 contracts at a time. Their algorithms are very, very stealthy. They may trade one lot, but they're capable of trading, okay, hundreds, thousands, okay, of them per minute. Like literally one firm can trade, 1,000 of them very much undetected, doing one at a time in the course of a minute. In fact, you can see right now inside of the marketplace, there's some pretty big volume bursts going on, which is indicative of, again, the algorithms are kicking in right now and they're selling into selling. Why? Because they're trying to hedge the net delta. Now, this stuff gets a little bit wild, a little bit confusing. So throughout the course of all this hedging activity, the marketplace actually gets almost like seams, all right, of risk, where ultimately buyers and sellers meet. This seam of risk happens to kind of what I call the happy delta area. It's an equivalency of the delta being neutralized amongst many, many derivatives firms. So effectively what you get is, again, this seam in a marketplace. That seam in the marketplace is why we call it kind of the gravity point, because you're drawn into that happy place. And when I say the happy place, again, I'm being a little bit facetious with this, but that's where the risk, okay, abates. And what happens as soon as you get to a gravity point, driving to the gravity point, there'll be big volume bursts. Getting to the gravity point, volume will subside in the S&P futures. Breaking off a gravity point, volume will absolutely explode. So volume has a lot to do with determination of where these gravity points live. Now, what I do is, yes, I look at some of the volume in the S&P futures, right? And by looking at some of the volume, and again, I'll show you here, as we start to slip away from this 2731, you'll see some, again, vicious volume spikes. And that's because all of a sudden, right, firms, what do they have to do? They have to turn the algorithms back on and hedge now to the downside. They'll actually sell into selling. It's dynamic hedging. Now, the volume spikes alone don't do anything, right? Then what I'll actually do is I'll go through and I'll look at the volume spikes in the S&P futures. All right, and then, all right, I kind of have an idea. Maybe this level means something, but we don't know exactly what price point. Then we'll actually go back and we'll do some regression analysis. And some of the regression analysis I'll do is I'll go over and I'll look at the volatility futures. And if the volatility futures all of a sudden spike like they just did a moment ago, that would be indicative of, again, of breaking off of a gravity point, but I still don't know exactly where that gravity point happens to live. That's when I'll start looking at bond products. Okay, is there any unusual movement per se in the bonds at this time? I'll do regression analysis and look at things like even into the XLF, because that big volume spike that happened just moments ago inside of the S&Ps, right? It reverberated right here into the XLF. It happened at exactly 12:45 Pacific time. So if I look at 12:45 Pacific time and I kind of zoom right here into the S&P futures, the exact same minute is going to see a volume spike. The interesting irony with that is I bet you I can go look over at a random product, even like Microsoft, and you'll even see volume spikes in Microsoft. And this is, again, this is all about arbitrage. So through a tremendous amount of regression analysis, okay, in fact, I even use like on demand, which I can go back days, months, okay, even weeks, and look at intraday trade. Through that, we're able to determine precisely where this particular level happens to live. Now, this 2731, this isn't new. And I want to reiterate that. You can go back 180 days. Yeah, we've been looking at trade for 180 days. Okay, you can go back a lot further in here. We can actually knock the time frame back, right, into the beginning of the year on a 4-hour basis. I'll just make a quick point with this, okay, that these levels, all right, of kind of concentric risk have been around and with us. And we were pinging back and forth in levels back in late January, early February, when that really heavy volatility struck the marketplace. When that really heavy volatility struck the marketplace, well, guess what the irony was, okay? 2682 right up here. We actually have 2731 in the S&P futures. Again, this was the first determination, of course, of that. It wasn't until later that I actually determined, okay, and we can actually come in here. There's also a 2626 gravity point. And again, these gravity points, I specifically will be able to pull them out as time kind of goes on if we stay in a volatile market. Now, if you look at all the gravity points together that we currently have kind of isolated here, I don't have one below 25.75. I don't mind saying that. There's nothing below 25.75. That's because we haven't had any recent trade there, you know, within what's well over a year since we've had recent trade at 25.75. And I'll try to grab more of these if by chance the market does break below 25.75. Now, part of the opinion piece. Well, I fully expect us to do just that. The market, okay, the marketplace as a whole, just, okay, in the last, 48 hours of trade, you have to realize that, yeah, today's a rally, and it's rip your face off rally is kind of what we determine and call it. We traded from, 2603, okay, and a straight shot into what? And again, remember how far we've actually come, 27, okay, 31. You're looking in the last 48 hours, okay, at a 130-point move inside of the S&P futures. And people ask, oh, well, is the volatility over? What do you think? What do you think? I mean, listen, this is shorts. They started covering, and we start to come up, you know, a little further. People really start to bite on the idea of the rally. I mean, when I say they start to bite on the idea of the rally, they're like, wow, this really is the most magnificent dip buy I've ever actually seen, okay? And that's how this stuff kind of gets perpetuated. Now, the volatility in the marketplace says something very, very different. The volatility in the marketplace, go look at the volatility futures for just a moment, okay? Look at this, the 21-day volatility futures, they're at 20.10. Move out a little further over here. They're still above, okay? Meaning that we have inverted volatility futures, which means that volatility is still very, very much with us at this point in time. The other thing that really stands out to me is, though, you know, 130-point move up inside of the S&P futures. What's the VIX done in that time frame? It came back down mildly. I mean, the VIX, again, it's laughing right now, saying like, you go ahead, you step out and buy first. It ain't going to be me. These gravity points, along with a little bit of look and detailed look into the volatility, are providing incredible trading opportunities. Very few people are taking advantage of these, though, and looking and not recognizing, all right, we hit 27.31, and yeah, well, guess what? We're also coming off like a rock. It doesn't necessarily mean that we're going to continue to fall, okay? But this is a point unto which you could actually exit risk and then play again. The wait and see game, well, we're pushing a little bit lower. Great. We'll trade, you know, bearish up until, again, you know, we hit another effective gravity point. Now, in the next 24 hours, we are going to have earnings from none other than Apple. Apple, okay, is going to throw a little bit of a spin into all of this. Why? Well, first of all, it's the largest market cap out there. Now, Apple is not displaying really any increased risk versus some of the previous earnings announcements. I want to throw that out there because there's this belief that Apple's going to have this unbelievable amount of risk. Listen, it's an $11.20 move on a $219 product. In the previous earnings announcement, it was a $9.20 move, okay, on a $190 product. I mean, that's basically like a 4.8% move versus like a 5% move right now that's being priced in, okay? However, the influence that Apple can have is it can cause, all right, this rally that we're seeing to perpetuate or sustain itself a little further maybe than you would have anticipated, which once again leads us back right to the gravity point. We could take off to the upside, right? The next definitive level that we have is not until 2811. Again, markets have been completely and hideously oversold. We have clearly been bullish on the markets since Monday. This is, again, that quintessential, what we term that rip your face off rally. Sit back, look for your entry points, okay? When I say look for the entry points, all kind of opportunities are opening up. If you want to sell out of the money call spreads, if you want to re-up some bearish positions, hey, look at the financials. They came directly to our level of 2650 and backed off, okay? Opportunities everywhere. Step up to the plate. Be careful of the Apple earnings. And with that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.